All right, got to get your thoughts on where we're at as we see this breather in stocks right now with yields, running higher and crude higher.
Well, I guess stocks could go down. We've seen it the last couple of days. It is possible. And you look at yields. One of the things we've talked a lot about at Carson Group, you for a while saying this, is this inflationary growth environment. So to us, it's not overly surprising that we have stocks doing well and, yields going higher. And I know it's a global story. It's like last Friday was the first 1% drop in a long time. Everybody realized, wow, global yields are going higher. Well, they've been going higher for a while. So we're not minimizing that. But I think in this world, with a little bit higher inflation, a little bit higher growth, we're still bullish, underweight bonds, but still overweight equities here.
Yeah, overweight equities because higher inflation tied to higher growth tends to be good for profit margins?
It does. And you look at profit margins, and lots of guests have pointed this out. We're looking at record profit margins, record earnings. Obviously, the guidance has been strong. But I think one thing, Morgan, that gets me is, yes, we're hitting new highs or flirting with new highs, right? But you look at sentiment. I mean, people just aren't that excited. And I know tech maybe is a little different, but the market in general, look at some of the recent magazine covers, you look at sentiment polls, it's really not this over-the-top optimism. Listen, the NASDAQ 100 was just up 27% in 28 days. That's a stretched rubber band. We're due for a little bit of break consolidation, getting a little geeky with technicals. We're hitting new highs. Less stocks are above their 50-day moving average, 20-day moving average. These aren't like end-of-the-world things, but this is maybe a little pause after 7 new highs in just the month of May by itself is due, but still bullish, I think, big picture.
Yeah, I mean, you just touched on it, but the S&P, arguably, looking at the technicals, overbought levels here, and we've been there for over a month.
Yeah.
And that said, about a third of the stocks in the S&P 500 are actually oversold still, and just 29.8% are overbought. So it really kind of speaks to the narrowness of this rally as well. So where do you see the opportunities?
It does, and obviously we know tech was the big reason why tech's kind of pulled everything up. We'd say a little boring, but keep a diversified portfolio, but stick with the cyclicals. We like tech, we like industrials, we like financials. And listen, financials has been very, very weak. Wouldn't be shocked at all if that baton was passed from tech to financials. As again, the economy continues to do pretty well. Look at just that manufacturing data we've seen the last week or so, right? It continues to come in better than expected. So I think those are the areas we like. And then, I call you said this before, but if you drop it, hit your foot, and it hurts, you probably want to own something like that. So underweight bonds, we have some managed futures, we have some gold, hard assets, real assets. That other bucket of stuff, I think, has really done well this year. And I think that'll continue the second half of this year.
Yeah, gold's been weak, though, recently. What do you attribute that to?
It has been weak. Obviously, well, it was up 65% last year, up 25% until the end of, right around the end of January. So I think just due for a little pause. I mean, there's some issues with real yields. The bottom line, gold does not want a hawkish Fed, right? That's kind of a little bit of that weakness. So we have in our overall unconstrained models, maybe about a 2.5% allocation of gold. So nothing wild there, but I still think it makes sense to own a little bit of gold in a portfolio here.
One of my favorite things that you bring to the table is all of your stats tied into history.
Yeah.
Historically, we've always said sell in May, go away. You would probably counter that.
We would. You look at May, it's higher 9 of the last 10 years. And even the sell in May, go away period has been really strong. Now, one thing, little stat here, we're up 7 weeks in a row on the S&P 500 and up double digits during that, Morgan. Only happened 7 times in history. Small sample size, yes, but let's not ignore this. 1 year later, higher every time. In the last 3 times, going back 30 years, you're up 20% a year later. So I'm not saying that's the case, but this blast of strength we've seen is still, to us, a sign that probably have a surprise summer rally. I don't know if it's a surprise at this point, but a surprise summer rally and still strength going into the end of this year.
Okay. So in light of all of that, what do you watch? I mean, we're going to talk to you a little bit more about all of this a bit later today, but it sounds like you steer clear of bonds for now. What would you be watching in terms of those levels and how it interacts with stocks? Yeah, I mean, listen, you mentioned before we came on, you've got obviously some of the highest levels in 30 years on the 30 year. So I think the global picture, though, continue to watch what's happening globally with bonds and with yields continue to move higher. And again, it's not as easy as, well, higher yields are inflationary. Yes, to a degree, but we think a good deal of the higher yields also saying there's economic growth coming, potentially global economic growth coming. So that's one thing we push back on from a narrative there.